What is happening, everybody? It's your boy, Chicago. No, I say that every once in a while. My old Twitter handle was Chicago Sean. I had that for so long, for like 12, 15 years, something like that. I've been in Colorado now for 13 years, and so I had to change my name because it just didn't feel right to be Chicago Sean anymore. I'm Options Sean on Twitter X. I'd like to be just Sean McLaughlin on Twitter X, but there's a squatter. Did you know that? There's a squatter on my handle, a guy who hasn't tweeted since 2007. That's right, look it up. I've begged Twitter, X, and even Elon Musk. I said, hey, this guy, this account, it's dead. It's been dead for 15 years, longer. Can I take it over, please? I am the real Sean McLaughlin. Anyway, deaf ears. Falls on deaf ears. So, guys, this is the What Are My Options show. This is a completely unscripted show that we do where um, I'm happy to talk options, talk shop. If you have questions about option strategies, if you have questions about a trade you're looking at or considering doing, you want some insight, you want to know what I see, um, whatever. This is a show for you. I got some things that I wouldn't mind talking about that we can get into in a little bit here. But if there's anything there's an options related question that's burning a hole in your head and you'd like to ask me, because maybe I have the answer. Maybe. I'd love to hear it. So put your questions into the chat there. I'll see it on YouTube there. And yes, TT, happy Fed Day to you for those who partake. I don't know how you celebrate Fed days, but the way I celebrate Fed days is I tend to do less. I don't like I don't like putting on positions right ahead of a big Fed announcement. Most of the time, Fed announcements ultimately end up being big nothing burgers, right? We sure will have some volatility in the immediate, 30 to 60 to 90 minutes following the announcement. Sure, it'll be all over the place. The algos are just battling against each other really at that point, so you'll see some whippy action. At the end of the day, though, and at the end of the week, Fed action tends to generally be a nothing burger, but that's not always the case. And we have certainly seen, and I have certainly seen some major pivots in the market, both up and down, coming out of Fed meetings. I'm not saying that's going to happen here. I'm not saying that at all. But because of that, I generally don't like to put on new trades ahead of a Fed day. That's just me, or on the Fed day, right? I put trades on yesterday, sure, but and I'll put trades on tomorrow. But just in the immediate aftermath, just because things could get wonky. That's it. Call me superstitious. Call me old. I don't know. All right. So Randy threw some tickers in there, and TT threw a ticker in there, and oh no, Ari's just saying good morning. He doesn't want to see GM. Good morning, Ari. All right. Let's talk about Cipher. Curious about my thoughts on the Cipher options chain. Well, is there anything in particular I should be looking at on the chain? Here's the chart. If you want to pull up my chart there, Gene, just to give people a little bit of context. This is Cipher, CIFR, Cipher mining. It's been a high flyer. This thing, I mean, boy, when this thing cleared the $7 level back in late August, it went on quite a rip. But let's bring up the options chain. Let's see if there's anything that I need to be paying attention to there. Let's see. Well, one thing that stands out is if I look on the right side of my options chain here, we see very high implied volatilities. No surprise if I look at the chart here on this platform, you'll see at the bottom of my screen, I've got this blue trend line here. This is implied volatility. For those of you who don't know what implied volatility is, that's basically the measure of the expensiveness of options, to use layman's terms, right? When this line is high, like it is right now, it's at the highs, near the highest levels it's been all year. That tells me that implied volatility is very high. You're going to pay higher options premiums to get involved in Cipher. When volatility is low, like it was here at the beginning of the year, options prices are cheaper. And options prices being expensive or cheap aren't, that doesn't necessarily mean that's a good or a bad thing. Like high is not good and low is not bad and vice versa. It just informs what type of strategies you're going to want to use to express your bets. When volatility is high like it is right now, it's tough to be a buyer of options. If you're bullish on Cipher, do you want to just buy calls here? You can do that, but you're going to pay up for that, and you're going to need a bigger than normal move for those options to pay off for you, whether you're making a bullish bet or a bearish bet, right? If you're buying calls or buying puts, you're going to need a bigger move to make those options paid. Now, it doesn't mean that can't happen. We've seen it happen time and again, but just know that when premiums are high, you're gonna it's not advantageous to be buying options. It's better to be an options seller because what do we know about implied volatility in options premiums? We know that implied volatility in options premiums tend to mean revert. That means that when options volatility is high, it tends to come back down. Now, it never comes down on my schedule. It doesn't come down on your schedule, but we can make pretty consistent bets knowing that eventually implied volatility will come back and mean revert, meaning come back down. And why does that happen? It comes down to human psychology, right? When options premiums are elevated like they are now, it's because one of two things. Options players are either being aggressive because they expect a big move and they're trying to be opportunistic and they're paying up for to be speculators, right? Whether bullish or bearish, they're willing to pay higher prices because they see a big move coming. Or it's because people are nervous, and particularly when you're a long holder of stock, if you have a long stock position, you get nervous if you think it's going to sell off, that there's like earnings coming up, which in this case, there are earnings coming up soon in Cypher. People are going to pay higher prices for puts to protect their call or to protect their long stock, right? Or if you're short, I feel bad for you if you're short this stock right now. It's been a tough road if you've been short for any length of time here. But if you're short, you're going to pay up for calls to protect your position in case this thing runs against you. That's fear and that's greed at play, right? But that tends to mean revert because what happens is whatever the thing, whatever the event was that got people excited to buy this stock, or whatever got people excited or nervous because that they're hedging their positions because they're worried about a potential move. Whatever that news event was, that news event either comes to pass and then once it's in the rearview mirror, we don't need to worry about it anymore. We're not scared about it anymore. There's going to be less demand for protection. There's going to be less demand by speculators because the move is already played out, right? So options premiums will come down. Or let's say the worst case scenario that everybody was worried about is realized, and that does happen. Okay. Bad news, the bad news that we were worried about becomes real. Well, once that news becomes real, as bad as that news might be, as humans, we adapt to that. And that new bad news, that new world order that you don't like or whatever you want to call it, it becomes the new normal and we adjust to it. We get used to it. As humans, we just get used to that. And that too will be reflected in options premiums. Options premiums will come back down. People aren't worried about a big move now. Yeah, maybe they're unhappy with the new state of the world or state of their position or state of their company they're invested in, right? But the fear will be gone because we're getting used to this new normal. So sorry for that long dissertation on options premiums, but I think it's important. But anyway, going back to the Cypher chain, who was that asked about Cypher? It was TT. TT has not followed up with me, so I don't know exactly what he's looking for in the options chain. Um, but look, if you like Cypher and you want to get long here, it's going to be tough to just buy calls. I wouldn't necessarily recommend selling naked puts here. This is one of those stocks that could, this thing could go from 18 to 10 overnight very easily. So I wouldn't be a seller of naked puts here. But one trade you could consider is perhaps a bull put spread. A bull put spread is leveraging high options premiums with defined risk. So a bull put spread is here. Let's mock one up here. Let's look in December options. They have 51 days to expiration, which by the way, when I'm a short seller of options, when I'm short premium, I like to position in the neighborhood of 30 to 60 days until expiration because that's the sweet spot where theta decay, that's the decay of the premium and the options, tends to accelerate. All right. Like if I sell options that have a year to expiration, from day to day, I'm not going to really gain from any theta decay. I want to be in that last, 30 to 60 days because that's where it'll really accelerate. So I'm looking at December options. They have 51 days expiration. Actually, let me pull up the chart real quick just to find resist support level. So it looks like 16, kind of the 16 area could be a good level of support, right? We've got the stock came down, it slipped through 16, but it closed above it. And then the next day it opened at 16 and rose and almost made a new high. So that feels like a significant level. Also, this was previous resistance on the first little push of this leg. So 16 feels significant. So let's look at looking at the December options. Let's look at selling the 16 puts, which right now we can get about, if you split the difference there, you could probably get about 230 for those puts. But again, I don't want to sell these naked. I'd have to have a really compelling case to sell these things naked. But what could do is sell a bull put spread. So that is selling the 16 puts, and let's protect it, let's say $5 away at the 11 strike. And that would net me about $1.77 credit because I'm selling the 16 puts and I'm buying the 11 puts. No magic on why I chose the 11. It was $5 away. It's just a width of a spread I'm pretty comfortable with. Let's let's see what this looks like on a P&L graph. So here's what this trade looks like. Let's zoom out. I don't know if you're unfamiliar with what a P&L graph for an options trade looks like. This is what it looks like. It's showing you across the x-axis. This is a range of prices. So sometimes this does this. There we go. Along the x-axis, this is the range of prices that Cypher could trade. Along the y-axis, this is the P&L. And we just did a 1 lot here. Let's like make the numbers a little bigger, a little bit more sexy. Let's say we're doing a 10 lot, okay? If we're dead wrong, the most we could lose in this trade is $3,200 on a 10 lot. How is that figured? Well, it's a $5 wide spread. So the most that spread could be worth is $5. All right. I'm collecting $1.77 to put the trade on right now. So $5 minus $1.77 is 333 if I'm doing my math right. 323, right? So the most I could lose is $323 per 1 lot. I've got a 10 lot on, so multiply that by 10. Most I could lose is 323 or $3,230. Okay. Defined risk. Now, if Cypher goes to 0, that would suck. But at least I know the most I'm going to lose is, in this case, 332 per contract. Okay. Now, the most I can win is the premium I collected today, right? If I sell this for $1.77 and Cypher goes up from here and the calls expire or the puts expire worthless, I keep that $1.77. Now, generally speaking, I know I'm not everybody. I can't speak for everybody, but for me, I generally like to cover short premium when I could buy it back for roughly 50% of what I collected. So if I collect $1.77 today, I'm probably going to buy this spread back for 85 cents. It's about half of what I collected today. That that does a couple of things. Number one, it takes the risk off the table, but it also improves my odds of success in a trade where I already have good odds of success. Let's do this. Let's change this level here. I'm doing a little math here, a little monkeying around with my platform here, but I have a greater than 50% chance of winning when I'm selling puts that are out of the money. Okay. If Cypher does absolutely nothing here, or even if it declines, it's trading at 19. You can see right here on the side, it's trading at $19 and change. I'm shorting the 16 puts. So Cypher could even drop $3 from here, but as long as it doesn't close below 16, I'm a winner. So I have a better than 50% odds of winning in this trade. And then if I buy this thing back at half of what I sold it for, I actually increase my odds of success. I don't have the math on that exactly, but it increases the odds of success dramatically. And when I'm putting trades like this on, I'm going for high odds of success. I'm not going for a home run trade. In fact, some of you smart traders will say, well, wait a second. The most you can win is $1.77, or maybe the most you can win is 85 cents if you're buying it back at half of what you sold it for. But you might lose 323. I don't like that math. I could lose a lot more than I can win. That seems backwards, right? I mean, people always say, oh, you want your wins to be 3x or 4x the times your losers. Yeah, that's true if you're a directional trader trading stock or you're buying options. That's a good target. But when you're selling premium, you don't have that ability. You're not going to get paid a lot of money on a high probability bet. You have a high probability of winning in this trade. And so if I put these types of trades on, I expect for every 10 times I do this trade, I expect to win 7 or 8 out of the 10 times I do this trade, right? And so that math works for me. Now, also, I should also point out, if I lose, it's pretty likely I won't take a full loss, right? Because I'll have some risk management in place. Like for example, let's bring the chart back up. If I'm in this trade and Cipher rolls over, and let's say it gets back below 16, at that point that is below 16, for me, this trade is dead. I don't like it anymore. I'm going to close it. It's going to cost me a debit to close it. It might cost me $2 to close it at that point. It might cost me 250. It might cost three, but it certainly won't cost the five. That's the potential full value of the spread. That I would pay the full potential value of the spread in a worst case scenario if we had a big gap against me, which certainly could happen. And so I have to size my position in a way to take that risk into consideration. Okay. But generally speaking, I'm not going to lose the full value of the spread. So I'm not going to lose the full value. I'm going to take profits at half. And those two things alone dramatically increase my odds of success over the long run, right? Like I said, if I do 100 of these trades, I expect to win on 80 of them, maybe 85 of them. And those wins, the sheer number of wins, even though they're small wins, that sheer number of wins should swamp the cost of the losers, right? That's the game you're playing when you're short premium. So I hope this was educational for some of you on Cypher. I think that's the way I would play it. Right now, if I were bullish this thing, I would sell a put spread. All right, let's see. Let me see. We have some other tickers in here. Shopify. Let's see who asked that. That was Randy. Hi, Randy. What's look at man, Shopify. This is rubbing salt in my wounds, man. I'll tell you. I was in Shopify. So me and JC and Steve Straza and the rest of the All-Star Charts team, we were in Toronto back in September for our portfolio accelerator event for some of our clients. And at that meeting, we talked about Shopify. In fact, not only did we talk about Shopify, we were we had an event, we had a happy hour one night right underneath a building or a Shopify office building. They had like one of their headquarters there in Toronto. I don't know if it's their main headquarters, but they had a big office space there in Toronto. And so Shopify was high on my mind, and it was a trade that I liked, and I got into it during that September. It was kind of right in here around September 12th, September 15th, I think it was. I got into the trade, and it looked like it was going good. We had a little brief sell-off. I held through that. Then we had another ripper. I was feeling real good about this trade, but then I got shaken out during this little drop-off here in just a couple weeks ago. And man, it just keeps going. So I have no position in Shopify right now. I'm a little salty about it because it's doing well. But this trade, looking at the implied volatility is at kind of middle of the road. I don't think I would want to buy call premium here. But this one has earnings coming up. Let me see if I can pull up the date on that real quick, because this will factor into what I was about to say. Yeah, we got earnings on the 4th. So what's that? Early next week? Yeah. So here's something I've been doing with trades with stocks that have earnings coming up. And this isn't for everybody. And in fact, I'll show you a real world example of where this trade I did recently in SoFi, show you how that played out. It was a winner, but a little disappointed in that one as well. But one thing I've been doing is when earnings are coming up, I have been employing calendar spreads. So on my screen here, I want you to notice on the options chain, look along the right-hand side. Now, ugh, can't talk. Every options platform is different. They will all display this data in different ways, but I'm pretty sure your options platform has this data. And if it doesn't, well, maybe you got the wrong options platform. But here on the right-hand side of the options chain, you can see these percentages. This is the implied volatility at each expiration. And you'll notice, and this is a phenomenon you notice quite often as you approach expiration or as you approach earnings, is that there'll be more implied volatility at the options expirations that are nearer in time than the ones that are further away. So, for example, these options expire November 7th. See there, they got a 98% implied volatility, right? But if I go down here to, like, say, September of next year, a little bit, almost a year away, the implied volatility is only 53%, just a little bit more than half of what the implied volatility is in options that expire in 9 days versus what expires 324 days from now. And so a call calendar spread or a put calendar spread, but in this case, let's do a call calendar spread because I'm bullish on shop. A call calendar spread could be a good play to take advantage of an earnings play. Why? Remember that discussion we had earlier about how implied volatility tends to decline following a binary event because whatever it was that people were being super speculative about or super hedging about, whatever that risk was or whatever that unknown was, that unknown becomes known. In this case, that's earnings. All right. The implied volatilities in the nearby options right now are juiced because of this earnings event that's coming up. We could take advantage of that with a calendar spread. Let's say I'm bullish on shop and I'm looking at this chart and I want to be an owner of the 200 strike calls, right? I'm thinking the stock's going to make a $200 roll. Okay. Well, check this out. Let's go here. Let's look at the November options that have a 73% vol. Actually, no, let's go even sooner. Let's do the November 7th weekly, right? These are options this is the first options expiration that happens following earnings, right? So these ones naturally have the highest implied vol, that 98%. So let's look at the 200 strike. Okay, you can see the 200 strike calls with 9 days expiration, even though these are almost 20 points out of the money, they got some pretty hefty premium there. You're going to pay about 475 if you middle out there. You're going to pay about 475 to buy those calls, maybe as much as $5, depending on how generous the market makers want to be, right? That's a lot. But if I want to be an owner of the 200 calls, but I don't want to buy them in November or these options expire the 9th. I'm thinking, I want this thing. This thing's going to trend coming out of earnings that we're going to have a nice little run here. I want to position a few months out. Let's look at March. Right? March gives us about 4.5 months to expiration. The March 200 calls are trading at 19 bucks, 19 and change. Okay. Well, I don't want to pay that full price. I don't want to pay 19 bucks. I want to pay less. Using the calendar spread, I can do that. So let's check this out. I'm going to go here. I'm going to craft this. I'm going to go to the 200s. I'm going to select buy. Actually, I'm going to analyze this. Go analyze by calendar spread. Okay. Let's do this. So hold on. Hide positions. There we go. Okay. We're going to sell the November 7 call, 200 calls, but we're going to go out to March. Okay. And if I do this spread, instead of paying, remember, if I go back here, remember, instead of paying, here we go, March, instead of paying 19 bucks to buy these March 200 calls, I can do a calendar spread to get those March 200 calls, but only pay 14.48. Now, there's a caveat, of course. I've sold these November 7 calls against it for roughly $5, lowering my cost. But of course, this also caps my upside temporarily. And that's the key, temporarily. If Shopify has their earnings event and the market likes it, okay? The stock's trading at 181 right now, but let's say the market likes it to the tune of stock opens up around 195. Like in the 190, 195. That would be a positive earnings reaction, not a bad earnings reaction, right? Well, in that case, going back to the Analyze tab, let's say the stock, trades up to 195. So see this little horizontal line here. And I'm going to fast forward in time here. Let's look at this November 4th, November 5th, and volatility comes in, which it likely will. You'll see this purple line here. This is my P&L on that day. I'll be up I'm analyzing a one lot right here, a one lot that I paid 14.48 for. I'll be up about $600, right? The goal here is that I really want that short call to expire worthless, okay? And I only have till November 7th. I want that short call to expire worthless, leaving me long the March 20th call at the 200 strike that I now own at a discounted rate. Instead of paying the 20 bucks, I got it for 15, right? That's the real thing that I want to happen. Now, it doesn't always work out that way. Let's say shop opens up at 200 or even beyond 200. You'll notice the structure of a calendar spread, the max profitability peaks at the strike prices, because once you get past the strike prices, if it goes higher, what's going to happen is that short call and the long call are going to merge in pricing, because the more these calls go in the money, less premium is in those options. It's all, at this point, intrinsic value. And those intrinsic values are going to converge to an equal price. So basically, you'll have to cover the short option and sell the long option, and you'll get roughly the same price for those. And so the max risk is defined to what we pay for it, this 14.23, but we don't want the stock to get too far away from our strikes, certainly on the upside. So what'll happen is if Shopify performs well and it does get up to 200 before my short calls expire, then I'll close the spread. Now, hopefully it'll be at a profit. I mean, this thing's pretty profitable all the way up to even 230, right? So I have a lot of room. I can win two ways in this trade. I can win if Shopify goes right to that strike price or in the neighborhood of the strike price following earnings, right? I can win that way and just take the spread off and book my profit and move on. Or Shopify can go up, but not quite to 200. Those calls can expire at the end of next week, and I'm still left with the long March calls with the possibility for unlimited gain from there. That's a great situation to be in. So these are trades I like to do heading into earnings because I can participate on some upside at a lower cost. I'm not paying that earnings premium, so to speak. And if I'm dead wrong, if stock tanks, again, the most I could lose is the premium I paid today. So I don't know. I thought, and let me actually pull up an example, a real world example of that. Let me go back to this graph here. SoFi. This is a trade that we were in. We got into it last week. We sold the October 31 weeklies at the 31 strike, and I wanted to be the owner of the April 31 calls, and I paid 390 for this spread. And in hindsight, in fact, I wrote about this yesterday. Went out of my newsletter, and if you're not subscribed to my free newsletter, the link is in the top of the chat there. Please click it. It's totally free. I drop a lot of educational nuggets in there. And yesterday we talked about this SoFi trade because yesterday, coming out of earnings, SoFi announced earnings yesterday, and the stock traded up to and through 31, which was my strike. In hindsight, I wish I had selected strikes a little further away. Perhaps I was being a little too cute or being a little too conservative. I don't know what, but I was at the 31 strike. But look, it's a first class problem. I paid 390 for it. I was able to get out for 495 yesterday. I was in the trade for a total of about 5 days, and I paid 390, got out at 495. So what's that? A 25% gain approximately in 5 days. It's a first class problem to complain about a profit. I wish it was bigger. I wish I had selected strikes further away. But it is what it is. But this is a trade that worked, even though it didn't work the way I wanted it to. That's the beauty of call calendar spreads. All right. Okay, Ari. Ari, you asked about Circle the other day. Let's check it out. I got the chart here of Circle. Let's zoom in a little bit because this is a recent IPO. Look, I like this name. I've been wanting to play this name. In fact, I did play it. I got in on this little pop here on October 2nd, but then got stopped out on October 10th. So I'm in it and I'm paying attention, and it's a stock that I want to own, but I don't want to own it below, I think, 153. I want it to kind of clear this little mushy area that I was caught in last time. If it clears 153, 154, I think this is the name you're going to want to get in on. I mean, look, it's crypto blockchain related. It's got all the sexy stuff that the people want these days. And this is one of those names that if it goes on a run, I mean, this thing could go back to highs up to 275, maybe get up to 300, go do a $300 roll. That would be a double, almost a double in the stock. Now, if you're trading with options, woo boy, you could even get some really fantastic leverage gains. But for now, Ari, it's a no play for me. I think it's just kind of, stuck in the muck here, but I'm keeping an eye on it. I've got alerts set in my platform to let me know when this thing's going to go. In fact, let's check out my alert. You can actually see it. Let's see where I'm at. Maybe I need to update it. Yeah, see, I got an alert right there set at 152, which, yeah, that checks out. That's kind of where I want to get involved. This is not an exact number, guys. It's just more of a ballpark. When it gets there, I want to be alerted, and then I'm going to start paying real close attention to it. But Ari, I do like it, and it's on my radar. All right, Royal Gold is a ticker that was in there from Cadiddle Hopper. Great name, great name. Let's set Royal Gold. I can't type. I mean, boy, this is one of those names that I rode during this little run up here. I got stopped out during the beginning of this pullback. I think right here on the 20th, I got stopped out. Happy to have gotten stopped out because it's gapped lower since. I think these gold names, I think they need to base a little bit. I think they need to consolidate. I'm not saying the gold run is over, but man, do we have some big runs in gold. I mean, look at GDXJ. I mean, probably looks very similar to the Royal Gold chart. I mean, this was quite a run from 70 to 112. We had a big win in here, one of our biggest wins of the year in the All-Star Options Service. But yeah, these things look messy, man. I think all the gold names right now, they need to consolidate. Some of the froth needs to come out. Some of the hot money needs to come out. Let these things form some bases. And you know, the bigger the base that we could get, the higher than space, they say, it could go on the next run. So no play for me. Let's see. What else we got here in the chat? Microsoft. Someone's mentioned Microsoft. Leah. Yeah, I mean, Microsoft, what a move yesterday. Um, that was coming out of earnings. You know, I kind of like this could be a great buy the dip candidate here, right? We had nice positive earnings. The market liked it, but it's been fading ever since. No surprise. But right now it feels like it's the market's rewarding the big caps, the large caps, things like Microsoft, Google, Nvidia, Intel. Um, this is a name I would be interested in buying the dip on, right? Volatility, interestingly, is still pretty high. Um, Earnings came out. Oh no, earnings are today after the bell, after the market. Okay, all right. Makes it tricky. I think I would sit this one out and see what happens tomorrow before I position. Because you're going to pay up for it right now buying calls. You know, you could do the calendar spread like we talked about. If you're really dead set, if you have a strong opinion on this thing that this thing is going to rip higher, you know, maybe a 580 call spread or call calendar spread could be a good play. Let's look at what something like that would cost us if we wanted to get involved. So we'll do the nearby option that expires this Friday. Look at the 580. I mean, there's a you know good premium there, 580. If we were to buy a calendar spread, let's go a couple months out at least. Let's go to January. Okay, it would cost you 969-ish right now to get into that spread. Could be a good trade. Could be a good trade. I don't know. I just the day of earnings, it's a little dicey. But man, I mean, this chart is just screaming buy, right? That's screaming a buy. Um, Maybe buying the dip here is the move in Microsoft. Let's go for it. All right, we got a lot of questions in here, guys, and I'm starting to run out of time. Let's go here through here real quick. I'm avoiding entering massage trades. Yeah, okay, great. A lot of earnings, a lot of earnings. Brian's asking me about TSLL. I'm in this, and I love it. And I'm in this because I rarely play these 2x, you know, leveraged plays on individual stocks. I think these vehicles are kind of obnoxious, to be honest. I don't know why we need them. But in the case of Tesla, I'm really bullish on Tesla here, but the Tesla chart itself, like the actual stock Tesla, I mean, it's a $450 stock. It's getting really pricey to trade this stock with options, right? So I could trade options on the TSLL, which is the leverage thing. These are the underlying is only $21. So I did get positioned in TSLL. I'm long. I like it. I think in this case, it's a vehicle worth exploring. Now, just remember with these leverage products, it's tough to get positioned for any length of time because there's drag that's built into these vehicles, right? All else being equal, if Tesla stock goes sideways, which I don't expect it to, but if Tesla stock goes sideways for the next, you know, however long, this position, this underlying will decay in value, kind of like options premium, right? Like theta decay. It will decay in value, and that's a feature, not a bug of these products. So when you trade these products, if you're going to use well, if you trade these products, let's say you just buy the underlying, like the stock, right? The stock of TSLL, you're going to want to have a shorter time frame, right? Because you're going to get caught in some decline, and then doubly so when you're buying options. Now I'm long calls in this Tesla or TSLL, but it's a short-term play. I only bought December options that expire, you know, in December. So normally I don't buy calls for swing trades with such a short time frame, but in this case I do, and I'm in it. TSLL, I like it. All right, let's see. Let's go through the rest of this real quickly. Okay, so Andy, I think I covered your request there, talking about calendar spreads, so that's good. Um, let's see, Tesla calls or puts. Yeah. Okay, actually, I think I covered everybody. One person asked about IBIT. That's the Bitcoin ETF. I've been, kind of caught in a little churn. You can see I got an alert set there at 70.15. I'd like to get involved if it gets back above there. I might lower that level and get involved at a lower price, but I'd like to see a little bit more consolidation first. But Bitcoin is just, kind of hanging, buying time, wearing the hot money out a little bit, getting everybody a little tired. Um, I like it. Again, it's on my list. You can see it. It's on my watch list. I have an alert. I do want to get into this if it gets above 70 bucks. But for right now, it feels like a no play. In fact, right now it looks like a good Iron Condor candidate. Guys, we haven't talked about Iron Condors on this show. An Iron Condor is a delta neutral spread where you're betting that the underlying is not going to move too far in either direction. You're collecting premium today and you're hoping to buy it back cheaper later. We'll do this. We'll mock this up real quick, and then we'll cut out of here. But let's do this. Hold on. Go to analyze. Let's go to December again with December. Let's get this out of here. I want to go December because that's 51 days expiration. That's right in that sweet spot when I'm selling premium. And with an Iron Condor, I want to sell out of the money calls and puts. Okay. Now, some people like to sell the 25 delta. Some people like to sell the 18 delta. There's really no magic here, but just keep it simple. Let's try to go to about the 15 delta. Delta shows up here, this column here on both sides. These are puts on the right, and these are calls on the left. So let's start with selling approximately 15 delta here on the December 52 puts. I'm going to analyze a Iron Condor and we'll sell it $5 wide. So if I'm selling the 52 put, I'll buy the 47 put to protect it. And then on the call side, I want to sell, let's say the 80 calls. Okay. They have a 14 delta. So I'm going to sell the 80 calls. This is a four-legged spread, guys. Don't be scared. I know. It's a lot of moving parts, but most of you have options platforms that allow you to easily create these four-legged spreads. Now look, it looks like I'm going to collect 73 cents. Okay. This is what the P&L graph of an Iron Condor looks like. Again, short premium. So we're not going for home runs here. This is not a home run trade. I'm risking the most the spread will cost to cover if we have a big move either to the downside or the upside is $5. That's the most the spread will cost me. I'm collecting 73 cents today, right? So subtract 73 cents from 50, and the most I could lose is 27 cents. I'm sorry, $4.27, right? $4.27 is my max loss. Now, again, like the discussion before with the bull put spread, I'm not going to let this thing go to full value if I can prevent it. If either of my short strikes are breached, meaning the stock trades below 52, which is right here, which is where my short put strike is, or if it trades above 80, which is where my short call strike is, if it breaks either of those levels, I will close the spread there and take my loss. Likely loss. It might possibly be a winning spread at that point, depending on when that breach happens. The closer to expiration it is, the better, the more likely it is I could potentially make money. But the bet I'm making is that IBIT is going to stay between 52 on the low end and 80 on the high end. That's the bet I'm making. Okay. And according to the math here, I've got let's do this. Set my, let's set my break evens here uh, on 1220. So according to the math, it's kind of faint. It's hard to see here, but there's almost 75% right here. That's telling me I have a 75% chance of winning in this trade. 75% chance that IBIT is going to close on expiration day higher than 52 and lower than 80. I have a 75% chance of that working out. Those are pretty good odds, right? Now I'm going to increase my odds of success on an Iron Condor by buying this back roughly half of what I sold it for. So if I sold it for 75 cents, let's say I'm going to buy it back for, I don't know, let's say 35 cents. Okay. A little bit less than half of what I collected. Smaller profit, but even higher percentage chance of winning. In fact, that might increase my chances of winning from 74 to maybe 85% chance of winning. And that makes sense because if I put these trades on, if I do 100 of them, I expect to win 80 or 80 to 85 times out of 100. And when I lose, I'm going to take some larger losses. My losses will be larger than my wins, most likely in most cases. but it's unlikely I'll take a full loss because again, I have risk management in place. I'm going to close these spreads if either of my short strikes are breached. So right now, IBIT feels to me like a good iron condor candidate. You can see the implied volatility is up near the higher levels, not certainly not on the lows. But that's the way I would play it. That's the way I would play IBIT right now. All right, folks, I think we covered a lot of territory today. We covered call calendar spreads. We covered bull put spreads. We even talked about iron condors, which we haven't talked about on the show yet. And maybe we're getting into a market where that might be something we could employ more often. So, guys, thanks for tuning in to What Are My Options? This is a mostly weekly show on Wednesdays. We try to do this every Wednesday at noon Eastern. Sometimes travel messes that up or certain special situations. But I'll always keep you alerted about it in my newsletter. The link to the free newsletter is up at the top of the chat. Please go in there and click on that and join the newsletter. It's absolutely free, and I share a lot of educational content. I think you'll find it very interesting, especially if you're into options. All right. Thanks for tuning in, guys. I'll be back tomorrow at 3 Eastern for the All-Star Options Jam session where we review action in the All-Star Options portfolio, trades we've exited, whether for a win or for a loss, trades where we maybe have made some adjustments to, or taking some profits on or partial profits on. We review big picture, what we're looking at in the market, what's affecting our positions, anything that we need to be aware of with our positions. And we'll update stops on existing positions and things like that. But that's also educational. You don't need to be an All-Star Options member to attend the All-Star Options Jam session. It's educational for everybody. Hope you'll tune in tomorrow at 3 p.m. Eastern. All right, everybody, I'm out of here. Happy Fed Day to those of you who celebrate. Celebrate responsibly. Do what I do. That is, put your hands in your pockets and just step away from the machine for a little while. That's good advice. All right, everybody, take care.